Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I missed last week's show where you implemented an option structure, essentially shorting the top 40, and it looks like it was very well timed indeed.
Yeah, it was well timed indeed. It's working out nicely for us. But that option structure, which we'll talk about it in a moment, but that runs out until September of this year. So it's still early days. So I'm certainly not counting my chickens just yet. But it does look at the moment as if we've put that structure on at a good time, and the participation that we get to the downside in our market is now well and truly in place for us.
Yeah, well, as you say, we'll talk about that in a moment. But it's interesting because what our local market has been doing is sort of in contrast to what the American market is doing, and we'll start off by talking about the S&P 500.
Yes, here's the S&P 500. Again, we look at this each week, and I've highlighted this in previous weeks as well. But I said all along that this 2400 resistance area was going to be quite important to monitor. We got a bit of a wobble in the middle of May, but then the market was very quickly bought back up towards that 2400 area. And I said at that stage that the fact that the buyers had stepped in so aggressively at those lower levels indicated to me that there was a strong likelihood that this market probably would push out above 2400 resistance. And you can see that that's exactly what's happened now. That circled area shows the recent trading action where this market has broken to the upside. It's traded up to as high as 2440. And I would expect, look, it might still keep going higher, but otherwise it might also just begin to consolidate from here. But overall, that's a pretty bullish chart setup for the time being, and you can't really deny that. It's making new all-time highs. It's broken through overhead resistance. So very constructive chart structure, actually.
Yeah, and not quite a constructive chart structure, I imagine, for the local market.
Yeah, the local market has come off a bit over the last 2 weeks or so. And last week on the show, I alluded to the fact that there was a possible head and shoulders pattern beginning to form. And I did say, well, I didn't know if I was being a little bit preemptive by saying that, because at that point, the market hadn't actually broken the neckline of the pattern. But it turns out that I was right. And you can see the neckline there at 47,500 on the top 40. This is the top 40 future, by the way. Yeah. It broke down below that 47,500 neckline, which then validates that head and shoulders pattern that you can see indicated there. It also marked a break below the bottom of that rising channel that we've been in since March. So all in all, it looks as if we're now in correction mode on our market. And I won't be too surprised if we bumble along and sort of drift a little bit lower. Maybe we bounce a bit somewhere along the line. But I think that this next couple of months could see the market being a little bit lethargic and possibly a little bit weak. And, you know, it's a cliche to say sell in May and go away. But actually, thus far, it's looking as if it might have actually been a good idea. And
it might have been quite a good idea to also just put on a naked short, because this is an option. So essentially, you're hedging yourself against downside risk in the markets. But you don't, and as you say, it runs out to September. So you've got to see where it ends there.
Yeah, that's right. So the payoff on the right-hand side of the screen you can see is actually the payoff of our option structure. So above 48,000 is where we pay away our premium of 2,300 Rand, and we've accounted for that, effectively kissed it goodbye. But in the event that the market comes lower, then you can see our real sweet spot is between 46,000 and down to 44,000, where the structure will make more than 17,000 Rand in profit. Now, today, I mean, I just checked my phone a moment ago. I think we're trading at about 46,100. So we're really close to the sweet spot here. But the critical thing is that this does run out to September. And I've got a nice linear payoff diagram there, but in reality, it's not as simple as that. This is how the payoff would look at expiry in September. So my view here is to actually hold it for the next couple of months and let the market do what it will do. I can trade around the structure. If the market really gets hit hard and gets into deeply oversold territory, I can buy against the structure and be a bit creative like that. But overall, you know, I'm pretty comfortable with the structure in place. And why I did it this way as opposed to just having a naked short that you referred to is having a naked short means that if the market continues to rally, then you lose money. Yeah. Whereas what I like about these option structures is two things. One is that I can go short knowing exactly how much my risk is going to be if the market continues to go up. So I effectively don't need a stop loss because the maximum premium loss is taken into account from the outset. The other thing is that doing it through an option structure like this affords me the ability to take a greater exposure than what I would ordinarily do if I was taking a naked short. I mean, to give you an idea, this is the exposure on this option structures effectively gives us a short position of 480,000 Rand to the market. Remember, we've only got 100,000 Rand of capital in our South African trading account. So that's pretty big exposure. But I'm comfortable with it because I know what the risk is.
Yeah, because if you take in that sort of exposure just on a naked shorts, you'd be having sleepless nights. Although
Correct.
I'd imagine right now you'd be smiling, but
Yeah.
it could be short-lived.
Yeah, well, that's right. And you know, we always try and limit our capital risk on trades to a maximum of 2% of capital, which in this case, the premium pay away is about 2% of our capital. So I'm very comfortable with this. And if the market does remain weak in the third quarter now, then we're going to really sit pretty with this structure.
Well, let's hope it's a better quarter. As we've seen the GDP numbers, it hasn't been an easy time for anyone in South Africa. We're effectively in recession. Certainly trading the market has been quite tough.
Yeah.
But the trade that you took in quite recently, which was on the offshore portfolio in Capita Group, seems to be doing quite well.
It is doing fairly well. This is Capita Group in London. So we did this on our offshore portfolio. Again, not to be confused with Capitec locally. Easy to make that mistake. The same share code and a very similar name, but it's completely different. This is actually a business optimization process, outsourcing kind of a business. Totally different. Not anything like our local Capitec. Anyway, it listed in London. What I liked about it was the fact that it had this rather bullish constructive pattern here where it was bumping up against overhead resistance at £5.85. And my sense was that with the pattern of rising bottoms and higher lows, that eventually this thing looked as if it was likely to break to the upside and we would probably see a follow-through move out the top. And so far it's looking good. We did see the price come off last week, and that was really only because the stock went ex-dividend of 20 pence. So nothing to be concerned about there. We received that dividend. It means we make about £88 on the dividend. I've also moved the stop loss down to £5.30. Our original stop loss was at £5.50, but now because of this dividend, effectively that allows me to adjust the stop loss down without changing the risk that we've got on the trade.
Okay.
So I've done that. In fact, I mean, if we hadn't have changed the stop loss, it would have probably been clipped on the move just below £5.50 last week. But because we adjust the stop loss lower to account for the dividend, we still are in the trade. And it's looking okay. You can see that the shares have been bought up quite aggressively following the ex-dividend, which is great. And it looks to me still like it's quite feasible that we're going to see a move to the upside here. So quite comfortable to keep holding it.
Just remind us what your target price was there, guys.
I was looking at about £6.40 or thereabouts for this one. That might be a little bit ambitious, but we'll monitor it on a day-to-day basis and see how it looks. But for the time being, once we've added back the dividend, we're up on this trade for now.
Well, speaking of ambition, your trade this week is in Sibanye Gold. It has the most ambitious CEO, I think, in the industry, but its shares have been distinctly underwhelming. In fact, I think a lot of people are really concerned about what's happening to Sibanye shares. Do you think, well, it seems from the position you're taking that you expect a bit of a recovery.
I do expect a bit of a recovery. So I think what we've got to do is just sketch the picture here and understand why this share price of Sibanye has been under so much pressure recently. There you can see the recent share price trading action in Sibanye Gold. You can see a big gap down there in late May, and then it's been selling off further since then. Now, the reason for that is because the company has embarked on a rights issue in order to fund the acquisition of the Stillwater Mining Company in the US. It's a predominantly platinum mining company, one of the biggest platinum miners in the world, actually. And the way a rights issue works is effectively the company goes to existing shareholders and gives them the option to plow in more money into the company in order to fund whatever this acquisition is. So in this case, what it means is that for every 7 shares that you previously owned in Sibanye, you now have the right to take up another 9 shares at a price of R11.28 per share. Now keep in mind that before this announcement came out, you can see the share was trading there at about R29 per share. And so, you know, having the option to buy more shares at R11.28, that's a substantial discount to what the shares were trading at before. But it's also a very, very big capital raise. I mean, effectively, you're more than doubling the size of the shares in issue here by doing this. And the way it works is that what you'll get is an N share, or SGLN is the code, which is a nil paid letter. So on the 24th of May, you would have received these SGLN, the rights, right? So if you had, for every 7 existing ordinary shares in Sibanye that you had, you would now receive 9 of these rights. Those rights actually trade in the market for a period of time. They're listed on the 24th of May. The last day to trade them is today, the 6th of June. So tomorrow, 7th of June, they will no longer exist. That window of time allows you to do one of two things. Either you can take up your rights, in which case you then use those rights to then exercise them and buy more shares in Sibanye Gold at 11 Rand 28 each. You then have to pay that. You have to pay the 11 Rand 28 for those new shares. Or alternatively, you might say, well, I'm not throwing any more money into this company. I don't want these rights. And you can sell the rights into the market and receive whatever they're worth at that time and get the cash back. Now, you can see, just looking at the share price graph of the rights here, these rights have been under an enormous amount of pressure since they listed, which suggests to us that there's been a very, very aggressive seller, or probably lots of sellers in the market not wanting to take up the rights. So they're simply selling them out into the market. And what that means is that there's effectively an arbitrage that becomes existent because whatever the rights are doing, the share price needs to adjust accordingly. Otherwise, there's an arbitrage, right? So natural market dynamics will ensure that the shares of the price of the ordinary shares, as well as the rights, stay intact with each other, all right? So hence you see this weakness in the share price of Sibanye Gold that we've seen over the last week and a half or 2 weeks here. My feeling is that this is a short-term market dynamic driven by the fact that there's an oversupply of rights in the market that's causing everything to be sold down.
So you don't think it's a fundamental dismay with the course of direction that Sibanye has taken, which would maybe exert long-term pressure on it?
I don't think so necessarily, no. I just think that it's a huge amount of capital that they're trying to raise here. This thing is fully underwritten, by the way. So just keep in mind, if shareholders don't follow their rights, there's an underwriter to take up the shares. Yeah. I just want to quickly look at a scenario here where we see something similar that happened very recently. This is a chart of Life Healthcare here, and this share also underwent a rights issue in late March, and you can see how the share price was under a significant amount of pressure then. And again, it was because there was a lot of selling pressure on the rights. Once the rights ceased to trade, then you saw that the share price of Life Healthcare recovered quite quickly. And I'm expecting that we'll see a similar thing in the price of Sibanye Gold.
So, Garth, you're going to have to whisk us through the mechanics of what you've done here.
All right, so I've gone long at 15 Rand 50. This is a mistake on the slide. 15.50 with a stop loss at 14 Rand. So if we quickly go through the mechanics, long at 15.50, stop loss 14 Rand, it means our risk per share is 1 Rand 50. I'm risking 2,000 Rand, which is 2% of our trading capital here. I take the 2,000 Rand and divide it by 1 Rand 50, which gives us, I've rounded it up to 1,350 CFDs. My target is somewhere in the 18 Rand to 20 Rand region. I know that's quite broad, but that's sort of the area we're looking at, which means that my risk to reward ratio is between 1 to 1.2 and 1 to 2.3, somewhere up there.
And I know that you had a chart which you actually haven't looked at the underperformance of Sibanye versus the other gold and platinum stocks, and that also ties into why you're backing this one. Yeah,
well, that's right. I mean, we can quickly have a look at that chart if you'd like, and here it is. Effectively, you've just got the three share prices, Anglo Gold, Amplats, and Sibanye Gold illustrated over here. And the reason those three, obviously, there's a gold share there, there's a platinum share, and now there's Sibanye Gold. And you can actually see this is just over the last 2 weeks. Notice how Sibanye has underperformed the other two significantly. And that's purely based on the fact that there's been a lot of pressure on the rights.
Yeah, okay. So to end off with, Garth, the portfolio has been quite active. What is it looking like?
Yeah, so here's our South African portfolio with our option structure. There's the premium that we paid away of 2,300 Rand. Then our Sibanye position is in the money. As we sit here right now, it's just over 1,000 Rand to the good. So we're up 3.5% in our South African account for the year to date. In our offshore account, it's looking a little bit better this week. We're up somewhat on that Capita long position, still down 3% for the year to date, but not the end of the world there.
Yeah, well, we have to leave it there. And also people should go onto the website if they want a weekly email alerts. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.